another episode of Equity Mates, final one for what has been a very busy week. As always, I am excited to be here, and so is my equity mate, Ren. How are you going?
Bryce. Very excited to be here. Very excited to end our week,
Yes.
not quite the week.
True.
We're going to be talking macroeconomics again.
We absolutely are. As we said on Monday, we would be bringing our in-house economist, Thomas, into the equation to help us unpack even further everything that is going on with inflation, with bonds, with yields, with house prices, all things macroeconomics. Thomas is the host of one of our podcasts, Comedian v Economist, where he unpacks the world of macroeconomics with his brother, who is a comedian, Adam, which is all very fun. So we've brought him in to unpack it all.
Yes. We are going to be, as you said, we're going to be touching on a lot of things. I guess without any further ado,
Yes.
Thomas, thanks for joining us today.
Yeah, g'day guys, how are we going?
Good. So look, the chat of the last few weeks has all been about, bond yields, inflation, stuff like that. Bryce and I did an episode on Monday about it, and we joked at the time that you'll come on at the end of the week and really show us up. So we've really set the expectations for you, but I guess let's start there. How are you thinking about all this conversation around bond yields at the moment?
Yeah, it is the talk of the moment. I've got a nice chart here looking at the Google search terms for bond yields, which is through the roof. So Adam and I jumped on that bandwagon and did a show on it yesterday. And it's causing a lot of confusion. It's not a simple topic. I don't know if you guys, when you guys did your studies, but back when I was at university, we used to think about stocks and bonds going against each other. One moving, one offsets the other. That's not happening at the moment. We saw a sell-off in, bond yields rose, prices fell, and then shares fell as well, particularly in the tech sector. So that's a little bit unusual. So trying to unpack what that is. We did see rates, yields rise in the US. We saw a sharp rise in Australia as well. Some charts on that. But the key story here, so there's the US bond yields. They're up enough to sort of cause a little bit of jitters in the US market. If you look at the Australian chart, that's the next chart there. You see a sharp spike there as well. So quite a strong pivot in sentiment in the market, quite unusual. And if you think about it, it does seem to be largely driven by inflation expectations. So markets, whereas they were pretty relaxed about inflation not that long ago, they're now starting to think like, maybe maybe all this story is going to create a lot of inflation. If you look at, we've got a chart here on the US money supply. So the next chart, I think, the US money supply has, it's spiked. So we've gone, that measure there shows the M2 money. So that's really gone through the roof because we've seen quantitative easing out of the Fed, coupled with a strong fiscal program out of Congress in the US. So that's caused a huge boom in the money supply. And we didn't see that during the GFC, even though we had quantitative easing back then. So this is really a COVID phenomenon, a huge spike in the money supply. And standard orthodox economic theory says that when you get a huge boom in the money supply like this, you're going to get inflation. And markets now seem to be thinking, whereas a couple of months ago they're pretty relaxed, now they're a bit worried maybe we will see inflation.
So Thomas, just on that, so recapping, we saw bond yields rise, which both here in Australia and over in the US, that caused a bit of a sell-off in the equity markets. And obviously the reason we're having this conversation is to unpack why. You've just shown a chart on the huge increase in money supply, and Economics 101 suggests that would lead to inflation. However, I guess the question is, to you being the economist, are we seeing inflation?
Yeah, not at the headline level yet. I mean, I think this is where a bit of nuance is coming out of modern monetary theories being useful, saying that you will see inflation, but only in those sectors where things are constrained, where there's sort of tight production markets or things like that. So we're not seeing any headline inflation yet, but we are definitely seeing it in some sectors of the economy. I've got a chart here on looking at the US, looking at commodities inflation versus services inflation. And what we're talking about here is like a K-shaped inflation outlook. So while the services sector, which is all your hairdressers and all these sort of things which have been really hit by lockdown, prices there are falling and being really hit hard. But in the real economy, we're starting to see, there's been huge disruptions to our supply chains. There's a lot of money coming into the system, a lot of demand. And so you're starting to see inflation in the real economy start to pick up. And so for the moment, that's not causing the headline inflation, which is sort of balances all these things out. That's not rising yet, but it's enough for people in the markets to think, oh, hang on, maybe we are going to get a bit of inflation here. So that's what's causing the pickup in bond yields. The reason why that translates into a fall in equities is because now people are thinking that the super easy monetary settings that we've got right now, with huge money printing, huge fiscal spending, that maybe that the government needs to sort of start winding that back. I've got a chart here on what the markets are pricing for the interest rate outlook. And they're now looking for a rate hike, at least one by the end of 2021, and then two by the end of 2023. And that's a pretty aggressive outlook and quite a big shift. I'm personally not sure that we'll get that, but that's what markets are starting to price in. So that chart there really says that markets now think that the era of easy money is over. That from here on, the Fed's going to start walking it back. We're going to start seeing things start to tighten. And a lot of the run-up that we've seen in equities, particularly US equities, particularly in the tech sector over the last year, that's really been driven by the expectation that the Fed and the Congress is going to keep money really easy, really loose for the foreseeable future. And so the idea that now, oh, hang on, maybe there's going to be inflation, that's going to cause the Fed to start walking things back a bit, start, pulling money out of the system, the end of super liquidity might be coming to an end. That now means that people are thinking, maybe this is peak cycle. I need to sort of look at my position, look at the valuations and think, am I overextended here, given that the easy money might be starting to unwind? And if you look at some of the metrics that we've got on the state of the market, it is easy to make the case that valuations are a bit stretched, maybe even a bit bubbly, to use a loaded term. But so that there's something called the Buffett indicator. So Warren Buffett famously in 2001 said that this total share market cap to GDP, that ratio is the best measure of where valuations stand. And right now that's at all-time highs. That's at a record level.
So what does that actually? I'll just jump in there, Thomas. What does that actually mean? Record high in terms of sentiment, investor confidence, that sort of stuff. Like, is it a good thing?
Not necessarily, neither good nor bad necessarily. What it's saying is that valuations, the total share market cap, is more than GDP, has risen a lot more than GDP has. And we should kind of think about the total share market cap as kind of being a proxy measure for the economy, because that's our productive sector of the economy. That's what the economy's doing. And so you should kind of see those things moving sort of together more or less. So a huge boom there. That's partly driven by two things. One is that GDP has suffered a hit in the US, so we haven't fully unwound the GDP lockdown effects, so the COVID lockdown effects. So that's affected that ratio to a degree, but we have seen valuations spike. So somehow those two have to correct. Either we'll see GDP pick up, and that's what a lot of people are expecting, or it might suggest that valuations are a bit overdone.
Yeah, right.
So Thomas, on that point, there, as you were saying, there's I guess a bit of a disconnect between GDP and valuations in the US. Well, on one hand, valuations could come back down in line with and be more in line with GDP. On the other hand, GDP could grow, companies could become more productive, earnings could spike. What does the market and what do investors, which scenario do they think is more likely at the moment?
Yeah, that's exactly the right point. So up until recently, I think the pricing was based on GDP coming back very strongly, that driving sales and profit growth. I've got a chart here for the US on earnings per share projections, and they were bouncing back. So they're really saying, the market's really saying, yep, all this money that's coming into the system, that's going to drive a massive boom. That's going to be great for corporate profits, and the earnings per share spiked. And so that's sort of what that story is saying, that they're expecting things to be really good for companies. How that plays out still remains to be seen. It does require the economy to fire and for that liquidity to make sense before we start triggering inflation and causing the Fed to start walking things back. The other thing that's sort of going on in this is you do have sort of some sort of bubbly things happening in the market. So I've got a chart here of NASDAQ over-the-counter volume. So these are sort of shares in companies that don't meet the requirements to list for whatever reason, but are sort of coming onto the market. And so there's really a huge amount of companies being fast-tracked into the market right now. And that's sort of, that's a little hard to make to square away with the COVID restrictions and lockdowns that we've seen, and an economy that's still underperforming where it was pre-COVID.
So Thomas, just jumping in there, sorry, with a chart like that, and you're saying a lot of companies coming into the market that don't meet minimum listing standards and that sort of stuff, what does that actually reflect in terms of fund managers and the risk people are willing to take in a market like this? Where does that sort of sit with you?
Yeah, I think what it says is that fund managers are really bullish. They're seeing all this money coming in and saying, like, it just doesn't matter. Let's just get into the market. Valuations will make sense in a few years once GDP catches up. Once all this money launches at things, the current valuations will make sense, and that's what will normalize things. Will square things away. I've got a chart here on fund manager confidence. Comes from the Bank of America survey of fund managers. They're now taking higher than normal risk. They say there's a question, are you taking higher than normal risk? The number of respondents saying, yes, I am, has spiked to all-time highs. So it has been, until bond yields spiked, it had really been a risk-on environment. All the sort of the cyclical outlooks, it's like, yep, the rebound's on, COVID's the thing of the past, it's just boomtown from here. And I'm going to take on more risk than I normally would in this environment. That's sort of what that's saying.
So Thomas, just to wrap up some of these charts that you've been showing us, money supply is at an all-time high. Expectations around future earnings are at an all-time high. The trading in sort of NASDAQ over-the-counter, I guess higher risk stocks is at an all-time high. Fund managers' confidence is at an all-time high.
And risk,
I mean, I don't want to say the B word, but I'm going to say the B word. Like, it feels like a lot of recipes for a bubble. Is that, do you have thoughts on that?
Yeah, I mean, I think, my personal view is if you look at how much money is coming into the system and how quickly it's coming in, I think it has been rational. The key pivot here is whether all that money comes in quick enough to launch the economy, to launch sales growth, to launch profits, to make share valuations make sense before we start triggering inflation, which then causes the Fed to start walking the easy money back. And so it's a bit of a dynamic of these two forces in the market and which one wins out first. So if we get the Fed starting to walk things back, tightening monetary policy before we see a boom in sales, then we might not see these share earnings per share projections realized. And in that case, it might be a bit of a bubble, and people might start to sort of wonder how they're positioned.
So Thomas, we are unfortunately running out of time, but obviously we can't talk macro without talking Australian property. So if we just jump to that, some of the news coming through at the moment just continues to be that Australian house prices are booming. Clearance rate, auctions, construction. What are you seeing at the moment in Australian property?
Yeah, it's hot. It's hot, and it's getting hotter. I think we saw the biggest monthly increase in 17 years on one measure. It's going through the roof. Auction clearance rates are at all-time highs, so the auction market is super hot. More properties going to auction to take advantage of this hot auction market. It's pointing to a really strong outlook for prices, which in turn is.
I was just going to say, is this why right now? Money has been cheap for a while. Biggest increase in 17 years in the last month. Fears of potential long-term interest rate rises may be coming through. What is the cauldron right at the moment that's driving all of this?
Yeah, it's definitely super cheap money, particularly when you can consider the pivot to fixed mortgage rates that we've seen that the RBA has facilitated through their term funding facility. So we've seen a big drop in interest rates, and it's really interest rates and daylight second when it comes to determining house prices.
Yeah.
And so that's really the main story that's going on. What's interesting about this is that unlike the US, where mortgage rates key off long-term government bonds, in Australia, we're really keying off the short-term, the term funding facility, which is sort of out to 3 years. So we're not going to see the pickup in bond yields translate into an increase in mortgage rates. Or if it did start to put pressure there, the RBA could sit on it pretty easily. So interest rates are going to remain low for the foreseeable future.
Yeah, right.
So on that point, Thomas, I think a few people might be asking, we started by talking about the risk of inflation coming back, and if the Australian economy does see inflation, surely interest rates will have to start, going up, and that may have an effect on house prices. Or is that the wrong interpretation?
No, that's right. But I think there's going to be, before we get interest rate rises, we're going to see the RBA start to walk back its quantitative easing program that it's got happening at the moment. So $5 billion a week that it's printing. It's going to walk that back, and then it's going to walk back its term funding facility. So right now, banks can access money at 0.1% if they lend it out in mortgages, rather than having to get money from the money markets. So that's enabling super cheap interest rates. So they'll walk that back, and then once they're happy with that, then they might look at an interest rate increase. But it's sort of why we're not talking about the official cash rate changing anytime in the next 3 years. No, I don't think there's any chance of that.
So there we go. So Thomas, we can put you on record here saying that there's a lot of dominoes to fall before interest rates rise. So I guess that makes you very bullish on Australian property for the foreseeable future.
Yeah, I think so. I mean, I'm not alone in that. I don't think there's anyone in the country right now that doesn't see prices growing anything less than 10% per annum over the next year or two.
Well, that's not great for us, given that we're a equity markets investing TV show and podcast.
And don't own property.
Yeah, and don't own property ourselves. But you know what? Great for everyone that does.
Absolutely. Well, Thomas, that's all we have time for today. It's always a pleasure chatting with you, and we look forward to bringing you back on the show in another month or so to continue unpacking everything that is going on in the economy and changing so quickly. So appreciate your expertise and your time today.
No, thanks, guys. Thanks for having me.
And that does bring us to the end of another week of Equity Mates. We hope you've been able to get something out of this week that has helped you on your investing journey. As we say, we are here to make markets as accessible as possible and all learn together. So it's been an absolute joy of a week, Ren.
Yeah, that's it. Hope everyone has a good Friday and a good weekend, and you'll join us same time next week, where we'll continue speaking to experts and unpacking the market.